United Airlines just pulled off a multi-billion-dollar magic trick, beating expectations on the top line while somehow eating a massive $2.3 billion spike in jet fuel costs. Welcome to Earnings Unscripted. It's July 16th, 2026, and today we're dissecting Q2 for United, ticker UAL.
Yeah, they essentially had to reprice tickets in real time just to survive it. I mean, GAAP earnings came in at $2.46 a share, and total operating revenue hit roughly $17.7 billion.
Which is a huge jump year over year. But before we figure out who's actually footing the bill for all this, a quick reminder that we're just two friends talking markets. This isn't financial advice, so definitely do your own research. Anyway, Miro, the company grew the top line hard, so I'm guessing the market loved it?
Not exactly. The stock actually took a pretty sudden hit in extended hours on the print. It gapped down hard and then basically spent the entire morning session grinding its way back up toward where it started. So a lot of sideways chop.
Right, which makes complete sense with how volatile fuel is right now. But if the broader market was nervous, their premium flyers definitely weren't. Business demand just looks exceptionally strong here. Plus, they literally pulled wide-body planes completely off the schedule just to install SpaceX Starlink hardware as fast as possible.
Exactly, because high-end flyers expect that tier of connectivity now, and it paid off. Their customer satisfaction ratings basically doubled on those flights right away. The broader story here is that unbundled commodity carriers are taking on water. If you want to survive this kind of cost inflation, you absolutely need brand loyalty and premium seat upgrades.
Which brings up a massive problem. The government is basically telling them they're out of physical space at core hubs like Newark. I need to know how they actually plan to grow an airline when the FAA says there's literally no more runway left.
They have one option left, and they call it gauge growth. The chief commercial officer specifically called this out. He said, "We are simply out of runway space in many of these key airports. It's why our long-term plan is to focus on gauge growth."
Okay, wait, gauge growth? Does that just mean like squeezing more seats onto the exact same planes? Because if they shrink the legroom again, I'm going to riot.
No, you get to keep your knees for now. Gauge doesn't mean denser cabins. It means physically replacing small regional jets with massive mainline aircraft on the exact same time slot. They're ripping out 50-seat planes and slotting in jets with 100 or more seats. So you don't need a new takeoff slot. You just move double the people.
Ah, got it. So they're artificially expanding the airport's capacity just by upgrading the hardware. That makes sense, but isn't that incredibly expensive? You're basically turning over an entire fleet.
Yeah, and that leads to this wild supply chain pivot they just announced. They're flat out stopping deliveries of Boeing's MAX 9 planes as soon as the 10 gets certified because the operating cost per seat on that larger variant is just significantly lower.
So they're stuck playing the long game on hardware while fighting immediate fires. Speaking of fires, how did they handle that huge mid-quarter fuel spike we mentioned? You don't just find billions of dollars lying around.
Well, they kind of did, actually. Early in the quarter, when they saw the Middle East tensions flaring up around the Strait of Hormuz, they quietly went to private banks and raised roughly $3.7 billion in debt. The CFO called it truly a no-regrets move because they used it as a war chest and then just took the excess to pay down legacy high-cost aircraft loans.
That's fascinating. So they basically took out a tactical insurance policy because energy pipelines were twitchy, and when they didn't absolutely need the cash to survive, they used it to clean house.
Right, except the fuel volatility completely broke how they forecast the business. They officially threw out their old playbook for earnings projections. The CEO said, "We have decided to once again be a leader by changing our guidance policy on fuel." Now, they literally tie their quarterly estimates directly to real-time forward curves from the Gulf Coast.
Wait, they update guidance continuously based on commodity markets? That sounds chaotic. Every time oil swings, their target moves. Doesn't that make profit sharing completely unreadable for the employees?
It definitely complicates the math. The union agreements cap those sharing tiers at specific margins, but the bigger issue, the real tell here, is just how brutal the baseline costs have gotten. Labor, airport fees, maintenance, it's all inflating. Their core unit costs, excluding fuel, went up roughly 6% year over year.
So the actual cost floor of running an airline is permanently higher, which explains why Scott Kirby said 4 of the 8 publicly traded commercial airlines are probably going to lose money.
Exactly. Those commodity carriers, they're drowning, while the legacy players survive entirely on the margins of premium cabins and credit card points. But the chief commercial officer just admitted their hugely profitable card deal with Chase is actively in its sunset phase.
So what happens to their bottom line if that renegotiation compresses those margins?
Well, that's exactly the risk. If they give up too much economics to Chase, their best defensive moat starts to shrink. Loyalty is driving a massive chunk of their system revenue growth right now. But honestly, if they negotiate from their current position of strength, it could actually unlock more capital.
Right. So it's just another giant variable hanging over them. Between the credit cards, the airport constraints, and the geopolitics, it feels like they're just running on a treadmill that keeps speeding up. How do you even project the rest of the year in that environment?
By completely changing the rules. We touched on this earlier, but they aren't using static estimates anymore. For the third quarter, they expect earnings somewhere between $2.50 and $3.50 a share. But that's built strictly on whatever the immediate forward fuel curve looks like on any given day.
Wait, so if oil drops, they basically crush those estimates. But if things escalate in the Middle East, the whole forecast is obsolete in a week.
Exactly. Though they did say they're aiming to pass through roughly 80 to 90% of those fuel spikes via ticket prices next quarter. The CFO essentially admitted if fuel just normalizes a bit, they expect to easily clear the absolute top of their full-year target.
So it really all comes down to how much pain the consumer is willing to take. You either buy a premium ticket and pay for the privilege, or you get pushed out. It's fascinating, but it also feels slightly ruthless.
It's survival. In an industry where half the players are actively losing money, being ruthless is the only way you afford to keep flying.
Fair enough. I guess we'll find out next quarter if passengers are still willing to fund the war chest. Until then, maybe double-check the legroom before you hit purchase.
Always a good idea. See you next time.
If you're enjoying these quick breakdowns, feel free to add the show to your podcast rotation so you never miss a quarter. As a heads up, this entire episode is an AI experiment in making earnings listenable, meaning our voices in the script are totally synthetic, designed to digest United's SEC filings into audio on the exact same day they drop. We'd love to hear what you think or which company we should cover next over on X, or just email us directly at earningsunscripted@datamadness.ca.
Get you next time.